The next learning objective is to prepare the statement of cash flows using the indirect method, the most popular method. So here are the cash flow steps. This is just a broad overview. We need the income statement and the beginning and ending balance sheets. So on the right side of the screen, at the top, we've got a screenshot of an income statement directly from our homework. And then down here at the bottom, we have a screenshot also directly from our homework of our last two balance sheets. So here's a prior year and here's the current year balances. Then we need to lay out our statement format. On the left, we're going to have a screenshot directly from the homework. The homework lays out the format for us. All we have to do is fill in the sections. Notice in the sections here, we've got operating activities first, investing activities second, financing activities third, and then at the bottom we have non-cash investing and financing activities. The next step is to compute the change in cash from the balance sheets. So we need to find our beginning balance for this year, which was the ending balance of cash from last year. So this $18,000 is going to go down here at the cash balance for 2015. And then we need the cash balance for 2016. It's going to go down here in the blue square. And then when you subtract the differences, that gives us our net increase or decrease in cash, which goes in the green box. Beginning cash minus ending cash equals net increase or decrease in cash. Next, we take the following things from the income statement. We need the net income figure. The $49,000 is going to go at the very top where it says net income. We always start with net income. We'll explain why in a little bit. And then we take figures from the income statement like depreciation expense, and we're going to add that here in the first section. Why do we add it? That will be explained in a separate video. And if we had any gains or losses on the income statement, those would go over here as well. From a previous video, you remember that we back out any gains or losses. So if you had a gain, you would subtract it. If you had a loss, you would add it back in. Then you complete the statement by explaining all the year-to-year changes and all the accounts on the balance sheet. So here's an example. Well, first of all, let's talk about the operating activity section. Besides depreciation, gains, and losses, what else goes in the operating activity section? Changes in current assets and changes in current liabilities. So let's take a simple example of inventory. Inventory is a current asset, so the change in inventory was going to go here in the operating section. But let's look at inventory. Inventory was $85,000 at the beginning of the period, and it ended up $89,000. So what happened? Well, we must have purchased inventory. We must have purchased more inventory than we sold. So inventory increased by $4,000. So if inventory increased, cash must have gone which way? Cash must have gone down. So we would subtract that $4,000 right here and say decrease in merchandise inventory. That's just a preview of some explanations we'll do later in some other videos, but that's just an example of what else goes in this section. And do you remember what goes in the investing activity section? Changes in long-term assets. So let's look at our plan assets. It looks like our plan assets went up from $30,000 to $149,000. So we probably purchased a whole bunch of plan assets. So we would put the change in here, and we would say since plan assets increased, cash must have gone down, so we would subtract that amount. Again, we will do these in more detail later. I'm just giving you a broad overview of what's going on. So once we fill in all these three sections and the fourth section, when you're done, you need to add up the change in those top three sections. So we take the operating activity cash flow plus or minus, because remember we could have a minus cash flow, from investing, and then plus or minus, depending on which way cash went, for financing. You add these all together, and that should equal the change in cash. This net increase or decrease in cash equals this plus this plus this. Operating cash flow plus investing cash flow plus financing cash flow. And then you're done. So thinking back to the statement of cash flows that we saw in the previous slide, it began with net income. So our statement of cash flows are always going to begin with net income. But remember, net income is an accrual-based number. What this means is just because you have $1,000 profit, that doesn't necessarily mean you have $1,000 cash. For example, you could have had all your revenue that makes up that profit. That $1,000 profit might have been all on account. So if you make a sale for $1,000 on account to a customer, you have a profit, but you don't have cash. So what we're going to do with the statement of cash flow is we're going to make adjustments to that net income figure, and we're going to convert it from an accrual basis number to a cash basis number. We're going to start with depreciation, depletion, and amortization expenses. Why we add these back into net income will be explained on one of the next few videos I'm going to be making for you. So don't worry about knowing why it's added. I'll explain it in a couple of videos. We already talked about our gains and losses on the sale of plant assets. Those have to be backed out. So you have to remove them from net income. And then we need to analyze our changes in current assets and current liabilities. So there's two ways to succeed in this chapter. You can either memorize these adjustments in Exhibit 16.6 right here. For example, the rule, if you're just following the rule, it says that you have to add depreciation. You have to subtract a gain. We already know why we're subtracting gain. And we already know why we are adding losses. We have to back those out from net income. And then we have to, if we have an increase in a current asset other than cash, for example, inventory is a current asset. If inventory went up, then we must have spent cash to purchase it. So cash went down, that's why we're subtracting. So in the next few videos, I'm going to run through all these scenarios: depreciation, increases in current assets, decrease in current assets, and increase and decrease in current liabilities, and show you why we're doing all these pluses and minuses.